You know what's wild? The United States government owes $38.5 trillion. That's roughly $108,000 for every person in America, man, woman, and child. But here's the question. Nobody really asks who actually owns all that debt. Who are the creditors? Who's lending America this staggering amount of money? Most people assume it's China. China owns all our debt. We're beholden to Beijing. You hear this constantly in political speeches, on cable news, and bar arguments, except it's not true. China owns maybe 2.2% of US debt. Important? Yes. The whole story? Not even close. The real answer to who owns America's debt is way more interesting, way more complicated, and way more important than the simplistic narrative suggests, because when you understand who actually holds US Treasury bonds, you understand the entire architecture of global finance. You understand why interest rates matter so much. You understand leverage points in the economy. You understand who profits when America borrows and who suffers when America can't pay. Let me take you through the real creditors, the institutions, countries, and individuals who collectively hold $38.5 trillion in IOUs from the US government. Some will surprise you, some will disturb you. And by the end, you'll understand why this debt isn't just a number, it's a web of dependencies that shapes everything. Here's something that sounds absurd. The biggest holder of US debt is the US government itself. Seriously. Of that $38.5 trillion, roughly $7.2 trillion, about 20%, is held by various US government accounts. The government owes this money to itself. How does that even work? Let me explain. Social Security Trust Fund. This is the big one. For decades, Social Security collected more in payroll taxes than it paid out in benefits. Surplus money came in. What did they do with it? They bought US Treasury bonds. By law, Social Security surpluses must be invested in special Treasury securities. So the Social Security Administration holds about $2.8 trillion in Treasury bonds. Think about what this means. When you pay Social Security taxes, that money gets loaned to the federal government. The government spends it on whatever, defense, highways, farm subsidies, whatever. In return, Social Security gets an IOU. When Social Security needs money to pay benefits, it redeems those bonds, and the government has to pay it back. But here's the problem. Social Security is now running deficits, more benefits going out than taxes coming in, so they're starting to redeem bonds. The government has to come up with cash to pay back Social Security. Where does that cash come from? Borrowing more from someone else. Medicare trust funds. Similar situation. Medicare holds about $280 billion in Treasury securities. Same mechanism. Excess tax revenues invested in government bonds. Federal employee retirement funds. Civil service pensions. Military retirement, other government employee benefit funds, collectively holding over $1 trillion in treasuries. Other government accounts, Highway Trust Fund, Airport Trust Fund, dozens of smaller programs, all holding treasuries. Added up, about $7.2 trillion of US debt is the government owing money to its own programs. Now, some people say this doesn't count as real debt because it's intergovernmental. The government owes itself, so it nets out, right? Wrong. It's absolutely real debt. When Social Security needs to cash in bonds to pay retirees, the government must find that money. It's not free money. It's not fake. It's an actual obligation that must be honored. Plus, this intragovernmental debt is growing as baby boomers retire and these trust funds start running deficits. The government will increasingly need to redeem these bonds, creating cash flow pressures. The second largest holder of U.S. debt, the Federal Reserve. They hold about $4.5 trillion in Treasury securities as of 2026. Wait, you might think, isn't the Fed part of the government? Sort of. The Fed is technically an independent entity, but it's quasi-government. Here's something alarming. U.S. debt ownership is highly concentrated in a few types of institutions, creating systemic vulnerabilities. Think about it. Social Security and government trust funds, $7.2 trillion. Federal Reserve, $4.5 trillion. U.S. banks, pensions, insurers, funds, $9 to $10 trillion. Foreign holders, $8.1 trillion. Households and others, $7-8 trillion. 4 categories hold almost all of it, and 3 of those 4, government accounts, Fed, domestic institutions, are deeply American. This creates risks. If domestic institutions face crisis, if banks, pension funds, or insurers face severe stress, they might need to sell treasuries for liquidity. Mass selling crashes treasury prices, spikes yields, creates doom loop. If foreign holders sell, China or Japan, liquidating even part of their holdings would flood the market, spike yields. This is a geopolitical weapon. Probably too costly to use, but the threat exists. If the Fed reverses course, if inflation forces the Fed to sell treasuries from their balance sheet, who absorbs $4.5 trillion? Markets might not have capacity. If government trust funds accelerate redemptions, as Social Security and Medicare deficits grow, they'll redeem bonds faster. Government needs to find cash somewhere, probably by selling more bonds to someone else. Here's the nightmare scenario lurking in ownership patterns. Many Treasury holders are sensitive to interest rates and inflation. Pension funds, they need certain returns to meet obligations. If Treasuries yield 4%, but inflation is 4%, real return is zero, not acceptable. They'd need to shift to riskier assets. Insurance companies, similar issue. If they can't get adequate real yields from Treasuries, they take more risk elsewhere. Banks, they hold Treasuries as safe assets. But if rates rise, the value of existing Treasuries falls. We saw this in 2023 with Silicon Valley Bank. They held long-term Treasuries that lost value when rates rose, forced to sell at losses. Foreign holders. If the dollar is weakening and Treasury yields are low, foreign central banks lose money on their holdings. They have incentive to diversify away. Here's the doom loop. Government borrows more. Supply of Treasuries increases. To attract buyers, yields must rise. Interest rates go up. Higher rates mean existing Treasury holders take losses. Some sell. Selling pushes prices down. Yields up further. Rates spike more. Higher rates increase government's debt service costs. Deficit grows. Larger deficit requires more borrowing. Once this loop starts, it's hard to stop without intervention. And the distribution of owners means many of them would be forced sellers in a crisis, accelerating the loop. U.S. debt ownership has become a geopolitical weapon in ways that create new vulnerabilities. China's holdings is leverage. China holds $800 billion. They could sell rapidly, spiking yields, creating U.S. financial crisis. This is the nuclear option. It would hurt China too. They'd take losses, destabilize global markets, but it's theoretically possible. The mere threat gives them leverage in negotiations. U.S. freezing foreign assets. After Russia's invasion of Ukraine, the U.S. and allies froze Russian central bank reserves, about $300 billion. This taught every other country a lesson. Dollar assets can be frozen or seized for geopolitical reasons. This makes foreign holders nervous. If the U.S. can freeze Russian assets, could they freeze Chinese assets, Saudi assets, anyone's assets? This fear drives de-dollarization. Countries diversify away from treasuries, not because they think the U.S. will default, but because they think their holdings might be frozen for political reasons. Domestic political weaponization. In the U.S., debates over debt ceiling become hostage-taking. One party threatens default to extract concessions. This makes treasury holders nervous. Even if default is averted, it always has been, the brinkmanship creates uncertainty. Remember, government trust funds hold $7.2 trillion. This is money owed to future retirees, Medicare beneficiaries, etc. But demographics are terrible. Baby boomers are retiring, fewer workers per retiree. Social Security and Medicare are both running cash deficits now, paying out more than they collect. This means these trust funds will be net sellers of treasuries for decades. They'll redeem bonds to pay benefits. Where does the government get cash to redeem these bonds? By selling new bonds to other buyers? But who? If domestic institutions are maxed out and foreign buyers are shrinking, yields must rise to attract marginal buyers. Plus, as these trust funds shrink, it reduces embedded demand for treasuries. One of the guaranteed buyers is gradually disappearing. By the 2030s and 2040s, this becomes acute. The government will owe trillions to Social Security and Medicare, but the trust funds will be depleted. Benefits will be paid directly from general revenues, meaning even larger deficits and more borrowing. The ownership structure of U.S. debt means demographic changes directly translate into higher borrowing costs. For decades, the prevailing view was, there is no alternative, TINA, to U.S. treasuries. Where else can you park trillions of dollars safely? Eurobonds? Germany's market is too small. Japan? Negative yields and demographic collapse. China? Not trusted, capital controls. Commodities? Not enough gold or oil to absorb the money. So everyone bought treasuries, not because they loved them, but because there was no alternative. This is changing in 2026. Gold. Central banks globally bought record amounts in 2024, 2025. Over 1,000 tons annually. Gold is becoming a viable reserve alternative again. Diversification strategies. Instead of 60% treasuries, countries are doing 40% treasuries, 15% gold, 15% euros, 10% yuan, 10% real assets, 10% other. Diversification reduces treasury demand, Bitcoin and crypto. Some smaller countries, El Salvador others, are accumulating Bitcoin. While still small, this represents new competition for reserve asset status. Real assets. Direct investment in infrastructure, commodities, strategic industries. Instead of holding treasury bonds, sovereign wealth funds buy ports, energy companies, agricultural land. The TINA assumption is breaking. There are alternatives now. Maybe not perfect alternatives, but enough to reduce the monopoly treasuries had on safe asset demand. This means holders have more bargaining power. They can demand higher yields or walk away. Here's the critical question. If current holders stop buying or start selling, who steps in? Government trust funds will be net sellers. Foreign holders are stable or declining. Domestic institutions are approaching capacity limits. The Fed is trying to reduce holdings. In the past, there was always a buyer of last resort. In the 1970s, 80s, foreign central banks recycled dollars. In the 1990s, 2000s, China and Japan accumulated massively. In 2008 to 2020, the Federal Reserve became the buyer. In 2026 and beyond, who's the buyer of last resort? Option 1, the Fed returns to QE. They start buying treasuries again, expanding their balance sheet. This suppresses yields but creates inflation risk and dollar weakness. Also, there's a limit to how much the Fed can buy without destroying currency confidence. Option 2, financial repression. Regulators force domestic institutions to buy more treasuries, higher capital requirements for banks that include treasuries, mandatory minimums for pension funds. This creates artificial demand, but distorts markets and reduces economic efficiency. Option 3, yield spikes until marginal buyers appear. If yields rise to 6%, 7%, 8%, eventually someone finds them attractive. But at those yields, government debt service costs explode and the fiscal situation becomes unsustainable. Option 4, retail investors step up. The government launches massive campaign to get households to buy bonds, patriotic appeals, attractive yields, tax incentives. But retail is a small part of the market and unlikely to absorb trillions. Option 5, default or restructuring. The unthinkable option. Government can't find buyers at affordable rates, so it defaults, restructures, or inflates away the debt. Catastrophic for a global financial system. None of these options are great, and the distribution of current owners makes each option complicated. Here's something disturbing about who owns U.S. debt. It represents a massive transfer of wealth from young to old, from poor to rich, from future to present. Young to old. Older Americans disproportionately own financial assets, including treasuries, through retirement accounts, direct holdings. Young Americans, disproportionately, are the taxpayers who will eventually have to pay back this debt. The current generation is borrowing from the future, and the current generation, especially older segments, are the lenders who will be repaid. Poor to rich, wealthier Americans hold more financial assets. The top 10% of wealth distribution holds the vast majority of stocks and bonds. So when the government pays interest on debt, that interest flows disproportionately to wealthier holders. But the taxes to service that debt come from everyone. It's regressive. Future to present. The debt is being incurred now to fund current spending. Future taxpayers will bear the burden of repaying it. We're consuming now, billing our children and grandchildren. The ownership structure of debt reveals and reinforces these inequalities. It's not just abstract numbers. It's real transfers of resources across generational and class lines. Who owns America's debt matters enormously for global power dynamics. Dollar hegemony depends on it. The dollar's status as global reserve currency is partly because of the deep, liquid treasury market. Foreign countries hold treasuries, which means they hold dollars, which maintains dollar dominance. If foreign holdings decline, dollar hegemony weakens. Geopolitical leverage. China holding $800 billion gives them some leverage over U.S. policy. Not as much as sensationalized, but real. Similarly, U.S. ability to freeze foreign holdings gives America leverage. This creates mutual dependencies and vulnerabilities. Financial warfare. The ownership structure is a battlefield. U.S. can sanction countries by freezing assets. Countries can retaliate by selling treasuries. Both sides have weapons. Both have vulnerabilities. Alliance structures. Japan and allies hold large amounts of U.S. debt partly because of security alliances. It's a form of financial integration that reinforces political alliances. As those political relationships evolve, so might debt holdings. For individuals, understanding who owns U.S. debt reveals important truths. Your retirement is tied to government solvency. If you have a 401k, IRA, pension, you own treasuries indirectly. Your financial future depends on the government's ability to repay its debts. This isn't someone else's problem, it's your problem. You're both borrower and lender. As a taxpayer, you're on the hook for the debt. As an investor, through retirement accounts, bank deposits insured by government, you're a creditor. You're on both sides of the transaction. Inflation is the stealth tax. If the government can't pay back debt through taxes or growth, the alternative is inflation. Print money, devalue currency, reduce real value of debt. This hurts holders of bonds and cash, which includes most Americans. Diversification matters. If a significant portion of your wealth is in assets tied to U.S. government solvency, bonds, bank deposits, dollar-denominated assets, you have concentration risk. Diversification across asset types, geographies, and currencies reduces this risk. Some economists argue it doesn't matter who owns the debt. Debt is debt, regardless of holder. Others argue ownership matters enormously. Domestic versus foreign. Debt owed to domestic holders means interest payments stay in the country, circular flow. Debt owed to foreigners means interest payments leave the country, wealth transfer. By this logic, foreign holdings are worse. Stability of holders. Stable, long-term holders, like pension funds, are easier to manage than flighty hot money. The composition of holders affects volatility. Embedded demand. Holders who must buy treasuries for regulatory reasons create stable demand. Optional buyers are less reliable. Political economy. Who profits from government debt affects political dynamics. If wealthy holders profit from high debt and high interest payments, they have incentive to maintain the system even if it's unsustainable. The truth is, probably, ownership matters, but it's complicated. The same debt has different implications depending on who holds it and why.